Good morning from London. I'm Anna Edwards alongside Kriti Gupta and Valerie Tytel. We're an hour away from the opening trade. Here's what you need to know. President Trump unveiled a new round of tariff rates, confirming a 50% levy on copper imports due to come into effect on August the 1st. The Brazilian real weakens after Donald Trump threatens a 50% tariff on the country, calling for charges against the nation's former right-wing president Jair Bolsonaro to be dropped. Plus, Nvidia starts the $4 trillion club, becoming the first company to hit that milestone as AI continues to boost big tech.
Let's check in on these markets as we start the hour. We are continuing to see European equities outperform this week. Euro Stoxx 50 futures in the green, S&P futures in the red. European stocks have outperformed around 2.5% so far this week. Eurodollar not doing very much, treading water at 117.40. Fixed income, though, has had a great day yesterday. It's holding on to that rally yesterday. U.S. 10-year yield at 4.34 after that strong 10-year auction last evening. The countdown to the opening trade starts right now.
Trade, and a little bit of tech. Those are the two key themes that you want to keep an eye on that are permeating through this trading session, showing up in the commodity market, the currency market, even the stock market. But I think it's only fair to start with what's going on in Brazil.
Yeah, absolutely. We've had another day with a whole load of trade headlines. Let's start with Brazil, shall we? We saw the Brazilian real retreat on the back of this. And it's interesting for a couple of reasons. Firstly, this was a tariff that was higher than had been anticipated. There'd been talk of this being a 10% country rather than one that stands out for these reasons. But of course, it's part of the BRICS, and that's attracted the anger of President Trump recently, as we know in talking about India. But the other reason that this is really interesting is this is not about economics. This is not about a trade deficit. This is the US runs a trade surplus with Brazil. This is about politics. This is about President Trump stepping in to back somebody who he sees as his ally in Brazil against the current leadership. So that's a whole different dynamic when it comes to trade and what the ambitions and the aims of the Trump administration are. So Brazil is interesting. We also have confirmation on copper on the date. We were talking yesterday about how it would probably be 50% and end of July, beginning of August. Well, now we've had confirmation of that rate and confirmation of the date of 1st of August.
Yeah, I do think this will, at least for other countries who are currently in these trade negotiations with the U.S., just be a reminder that, Trump can really go after everything and anything. If you irk the president in some manner, whether it's politics or trade, he seems to be combative, at least on the tariff level that he wants to give your country. So maybe a reminder for those countries out there that irking the president at a time where these trade negotiations are going on is probably something they don't want to get involved in.
But it marks a real shift when it comes to some of the things and some of the tariff policies that Donald Trump has been targeting. In previous iterations, he's been focusing on removing tariff barriers like the VAT, like subsidization, et cetera. Now he's actively going after emerging markets where commodities, imports, the likes of copper, of course, but also the likes of coffee, for example, Brazilian coffee, a very famous export from Brazil to the United States, are largely going to affect American consumers. And I think that's where things like inflation come back and focus.
Absolutely. And that's really important. We've talked a lot of times on this program about when, where, how the inflation pass-through happens from the tariffs into the U.S. consumer arena. And there are differing views, and the Fed seems to be really divided. We'll come on to that in a moment. But I was really drawn to this story about Japanese car makers and the way that they have dropped their prices really substantially, dropped their prices 20% in June to combat the tariffs. And that's really fascinating. They're going to take so much of this on their margin to hold on to that market share.
And the fact that they're dropping prices even before the 25% on cars goes into effect, right? Right now, they're just dealing with the 10% baseline universal tariff. So it's interesting to see that these companies are already adjusting prices ahead of these tariffs being effective.
But I think that's the key piece, and we'll explore this with our market guests throughout the program as well. What is the biggest danger here? The fact that you start to see this margin compression for a lot of these corporations, or you see the underlying demand take a hit at the moment? And I'm not sure which one is a bigger risk when it comes to things like the equity market.
Let's talk about the markets then, Val, and how they have responded. Because I was interested, yesterday we had that real divergence in copper trade across the globe. And actually that caused some divergence in what we were seeing. The US equity market, it was positive, but the European equity market really outperformed, and it was auto autos, it was construction, it was things that use copper, which is going to get cheaper for the rest of the world, that did pretty well in yesterday's session.
Yeah, in yesterday's session, on the back of this post on Truth Social about the August 1st date, we did see COMEX copper lift about 2%. It's still off the record highs that it did reach on Monday, but it still seems to be jarring the copper market for the moment. And then if we can turn on to what we heard out of the Fed minutes, touching on this inflation debate, they were still pretty divided on what will be the effects of tariff on inflation. Most, though, did see a risk of persistent tariff impact on inflation. So to me, that's a July pause is very much on the cards. But several did observe that tariff pass-through still may be limited. So the discussion is still out there. But really what rocked the Treasury market yesterday wasn't these Fed minutes. We had a solid 10-year Treasury auction. We did also have a solid 20-year auction in Japan just a few hours ago. So it seems like this long-end supply is being taken well down by the market. We did see Treasury yields rally around 7 basis points after this strong auction, erasing much of the rise in yields over the last 7 sessions.
I saw some negative headlines around the Japanese auction, but is that not the message that landed with the markets? The market took it pretty well.
We did see the back end of JGB's rally after the auction. They rallied around 4 basis points. It's come back to flat now, but remember the disaster of the 20-year auction that was a few months ago. It's a point on the curve that doesn't attract a lot of demand, but they seem to get this auction off okay today.
It's a fascinating one. And, of course, the interest rate story is going to be reflecting very aggressively when it comes to where tech goes next. And I think that takes us nicely to the price action of the last 24 hours. We have a $4 trillion market cap company that exists in the world, in the public markets. One that's largely been driven, a rally that's largely been driven, I think it's fair to say, by momentum around the AI story. And I want to say good vibes as well, because there's a lot of concern around tariff questions, the currency impact, and, of course, what that shows up for in terms of accelerating the AI build-out in the United States. Nobody cares. People still want Nvidia.
There's so much genuine excitement and a lot of hype around the AI story, it would seem, to sort of bring the two sides together. I like how MLive were talking about this, asking the question around whether markets are complacent, saying that Nvidia has become the avatar for market FOMO, and it does feel that way sometimes. This is just the poster child, if you like. And talking about that market FOMO, Bitcoin rallied, along with Nvidia, along with risk appetite.
Yeah, a new record high for Bitcoin. It surpassed 112,000. But we're continuing to see reports of these big tech firms, make these capital expenditures. It was Meta yesterday. Now we had the FT reporting that Amazon is weighing investing a few billion in Anthropic. So this, I guess, uncertainty over tariffs is continuing to not hold back this kind of CapEx spending, this investment spending from AI.
Well, it tells you where this idea of, and you mentioned Amazon, the Anthropic story, and the AI story there as well. Amazon built their business on e-commerce. That was kind of ultimately the goal. So to see that more of their gains are coming now from AI than their actual commerce business, day one of a 4-day Prime sale, dropping 41%. This commentary that big tech in the United States is kind of this hodgepodge of 7 very different companies, I think no longer exists because the premium of big tech is now tied to how well they're doing on AI.
Let's move on to some news that's just been breaking this morning, shall we? And this comes to us from the advertising space. This, remember, was a story that we covered a lot yesterday. WPP out with a profit warning. We knew that their CEO, Mark Reed, was going. That's not new information. That was weeks ago that announcement came. But we now know who's going to succeed him. So Cindy Rose is going to become the CEO of the business. She will succeeding Mark Reed. Reed will continue to work with Rose to support the transition, we understand, until the end of the year. But this is talking of AI, talking of tech, this is a sector that can be very challenged by what is now available to content creators, for example, in the world of AI. So
it's just showing how maybe chatbots are changing the landscape of advertising. People are using the internet. They're not Google searching anymore and clicking onto links. They're using chatbots to get the quick and fast answer, and that's having an impact on the ad business.
We heard that from Bernie Akong, didn't we? He was keen to talk about that story to us. Lots more conversations coming up on this programme. Let us tell you what is coming up. Catherine Nice, PGIM Fixed Income Chief European Economist, will be with us. Lots to discuss there about the global economy, the European perspective, the defence build-out, perhaps. Anita, Anand, the Canadian Foreign Minister, will be with us from the ASEAN Summit. That summit taking place, a lot of trade conversations there, so no doubt that gives us a sort of global perspective from the ASEAN Summit. Virginie Massenet will be with us, Allianz Global Investors Equity CIO. We'll also be speaking to Bruno O'Hiri, hearing from Bruno Itua, Republic of Congo Minister of Hydrocarbons, from the OPEC seminar. That will be with Jemana Basecha. And we'll have a couple of guests coming to us from the Bank of America Breakthrough Technology Dialogue at Goodwood on the day that we mark, or in the week that we mark, a $4 trillion company in the United States, in the world of big tech. Probably a really good time to be checking in on European technology. Bernie Mensah will be with us, Bank of America's president of International, and Tony Fadell, the father of the iPod. I assume people remember the iPod, but maybe I should decreasingly assume that. There we go.
Let's change on to the possible risk events we have on the horizon today, because let's say it, earnings season begins today in the U.S. We have Delta Airlines reporting results for the second quarter. That'll happen before the bell. Also, we do get some economic data this afternoon. You know, it has been a quiet week for economic data, so this is the biggest one coming out of the U.S. Initial jobless claims, the weekly claims number coming at 1:30. Then later this evening at 6 p.m. is the bond auction, 30-year auction coming later tonight. As we just mentioned, many of these long-end auctions this week have gone pretty decently, pretty okay. The market seems to be absorbing all this extra bond issuance in the long end.
I think you might have just jinxed it. We'll find out. Here's what else you need to know this morning. Plenty of news around the world. Blackstone says it signed a private credit partnership with Legal & General that the two firms aim to grow to up to $20 billion over the next 5 years. It will see the U.S. alternative fund giant originate investment-grade private credit deals for the U.K. insurers' annuities business. Alternative asset managers and insurance industry tie-ups are seen as a key growth driver for the emerging private investment-grade market. And Bloomberg has learned that Ferraro is close to acquiring cereal producer WK Kellogg for about $3 billion. The shares of Kellogg surging as much as 56% in post-market U.S. trading after the Wall Street Journal first reported that the two companies were nearing a deal. Sources saying the tie-up could be announced as early as this week. Now, shifting our focus to what's going on in Brussels, European Commission President Ursula von der Leyen facing a no-confidence vote at noon today in the European Parliament. The motion submitted by hard-right politicians focused on her handling of Pfizer vaccine contracts during the COVID pandemic. While she is expected to survive the vote, it is a symbolic challenge to the leader at a difficult time for the bloc. And I believe the first no-confidence vote in Brussels in about 10 years. Really talks about the polarization you're seeing there. And speaking of Brussels, we should mention other media reporting as well, Anna, that maybe a little bit of tension between Brussels, Rome, Madrid. Expansion reporting that there may be a letter coming from Brussels to Spain saying that they overstepped when it comes to banking consolidation.
Yeah, it does seem that Europe at its centre is more keen on banking consolidation than some of the individual states, and that's a tension that we'll continue to watch. Coming up then on the programme, the EU reportedly, as Kriti was saying, opens an infringement probe against Spain over banking deals. We'll check in on the stocks at the open. Plus, big tech is in focus as AI powers massive growth. We will bring you all the updates on that sector. Up next, tariffs continue to grip global markets after the latest announcements from Donald Trump. We'll break down the market reaction to the latest tariff headlines. And if you want to get involved in any of these conversations around this desk, IB plus BBTV Go is the function to use. This is Bloomberg.
We just published research yesterday showing that there has been no tariff-induced inflation in a general price level since the tariffs began being implemented in January. Quite to the contrary of all of the Cassandras that were shouting that it was going to be extremely inflationary. There's just no evidence of that thus far.
Stephen Moran, head of the White House Economic Advisory Council, giving us his take a little bit on the tariffs and maybe the pushback against those tariffs. Let's talk about what we need to watch in the markets. Valerie Tytel has that for us.
Yeah, just first with a little check on how Brazilian assets fared yesterday after President Trump threatened this 50% tariff on the country. We did see the Brazilian real slide around 2.3%, and also their equity market was in the red, around 2%. This is the Brazilian ETF, EWZ, one of the most liquid ETFs, tracking the Brazilian market. But it should be said here, though, that the exports to the U.S. from Brazil only make up around 3% of GDP. It's a very small part of their export business, or I guess I should say the Brazilian economy is less open than other EM nations. I did also want to note that while we did get all these new headlines on tariffs, the U.S. equity market did perform very well yesterday. Those tech stocks intraday hit a new record high, and we did see Nvidia pass that $4 trillion market cap level for the first time. Another asset that we saw performing very well yesterday, turning around some of its recent declines, was the Treasury market. Those 10-year Treasuries rallied around 7 basis points after a strong 10-year auction, taking a decent chunk out of the sell-off that we have seen in fixed income globally of the last few days.
Valerie, thank you very much. So a host of market dynamics to keep our eyes on, from what's happening in emerging markets to the Treasuries, supply conversation, and, of course, tariffs. Catherine Nice joins us, Deputy Head of Global Economics and Chief European Economist at PGIM Fixed Income. Catherine, really nice to have you with us. So a host of subjects that no doubt we'll touch on a few of these with you. We'll come to tariffs in a moment. Valerie was talking about there's been a lot of focus at the long end of the US Treasuries curve, a lot of focus in Japan on the long end of the Japanese curve, about supply and whether the market can really digest all of this. And I wonder, in a European context, whether we should be paying attention to that, because sometimes we look for that global theme to show up in bond markets in Europe at 7:30 UK time, and it doesn't always. What's the read across or lack of?
So we did see long-end bond yields, for example, go up on the back of Germany's kind of surprise announcement of not just increased defense spending, but the infrastructure spending. Some of that retraced then, I think, as maybe expectations around, is this money actually going to be spent? Mm-hmm. Is it going to be spent in a way that's going to drive growth? So I think really from the European perspective, the pressure perhaps on longer-term yields is going to be around whether any spending commitments can really translate into more self-sustaining, higher potential growth. And that's the thing where I think there's a big question mark. We're getting to the end of these big next-generation EU funds that went to the periphery. We've seen great growth in the periphery. That money now is getting close to its end. And, you know, the big question is that actually going to lead to higher growth in those countries beyond, you know, the end of that program? And then for the rest of the core, you know, besides other than Germany, you know, we haven't really seen these commitments. So I think that's the question mark for Europe around long-end yields. And
even within Germany, a lot of questions about the growth, the multiplier of the fiscal spend that we're going to see out of Germany, and whether it's going to deliver for growth. And what is the risk to the European economy then from tariffs, as you would assess it, Catherine? Or is it just impossible to say right now because conversations are ongoing? We expect some sort of framework agreement at some point that might have a 10% tariff in with some exemptions. What is your assessment of European prospects with that in mind?
So there is still a huge amount of uncertainty, and I don't expect that it's going to get resolved. I think what we're hearing is that these negotiations are going to drift, and, you know, maybe by the time we get to the end of the year. So in some ways, that's kind of bad news, because the uncertainty itself is depressing, you know, decisions around investment, et cetera. So, you know, that's one bit of bad news. I think the other thing is, to me, and different people will read, you know, these media leaks differently, I am just getting a little bit worried that, you know, where we could end up is not really an average tariff rate of something that looks more like maybe just a shade above 10%, but maybe we'll end up with something that is just a shade below 20. And there is a difference between those two numbers. You know, it's not an ocean of difference, but it is a visible macro difference there. And so that those are the two things I'm just a little bit worried about.
We had a guest, I want to say last week, who said that the equity market in Europe is quite literally pricing in 10%, but not 20%. Is the bond market thinking the same?
That is my sense. That is my read, and this is why I'm a little bit worried about it. I mean, just coming back to your point about pressure on long-term yields, I guess, you know, the growth story is kind of a good reason, right, for longer-term yields to be higher. I think we would all accept that's a good reason for these prices to be moving in this way. But there is a more you know, negative way around, you know, the situation in France, which also is something that could be crystallizing when we all come back from the summer in August. They're going to have this debate around the budget for 2026. A lot of nervousness there. It's not unique to France, but can they actually try to rein in the spending? And if they can't, there's no such thing as magic maths, and the markets aren't going to like it. And that could be another factor that is pushing up on yields in some pockets of the euro area. That we should probably keep a watch out for as well.
You mentioned the periphery versus the core. We're also digesting this idea of what appetite for the long end of the curve around the world actually looks like. Can we marry those two thoughts, especially when you look at Spain, Italy, Greece, et cetera? The demographics, the wealth impulse into that actually favors long-term yields. Do you think the bond market on the periphery is going to lean into that or take its tune from sell-offs that we see in the 30-year gilt market, the 30-year OAT market, 30-year Treasury market?
So this is a great question. I mean, I have been, really quite banging the drum on the periphery for, really since the summer of 2020. This was a game changer for the periphery. And it is remarkable that the combination of reforms, bit of inflation, has really helped, bring their deficit and debt to GDP trajectory. And those spreads have just come steadily down. But I think with some of these wobbles that I've described in the second half of this year that I'm a bit worried about, tariffs maybe being a bit bigger than expected, ructions around France, even Germany, they've got to hammer out these details and convince us that it's going to deliver growth. I wouldn't be surprised maybe to see some of this move a little bit sideways when we get into the second half of the year. And I think markets are going to want to see real evidence of some self-sustaining growth for those spreads in the periphery to keep compressing further.
Catherine, you mentioned that we're watching for Germany to see how much this infrastructure spending actually gets spent in the near term. What kind of pointers are you looking at in order to assess how quickly this money is actually getting put to work? Because I was even reading something about how even in the German budget they promise spending, but don't always end up actually spending that amount. So how do we track that?
Absolutely. So they don't have a good track record of spending their announcements. So, a lot of these numbers are a bit to flatter.
What an amazing problem to have, or not, it would seem, because it persists.
So I think there's one thing I would say is, in my kind of conversations with policymakers there is, in terms of getting a kick right up front, is they're planning to spend quite a lot of this on the railroad infrastructure, where my understanding is that there's a lot of backlog of work that needs to be done, and they know what needs to be done. The plans are there, and so it can be executed fairly quickly. So I think in that sense, we can be quite positive that actually this money can start to flow quickly. But the point on the other side that I have not yet really seen is reforms. Because at the end of the day, what is the real blocker in Germany is not the money. This is a very wealthy country with low debt to GDP. What really restricts and blocks are regulations and the lack of skilled employment. And a lot of that is a consequence of just poorly designed, overly designed regulation. So we've got to see these reforms. But the problem is having announced all this money spent before the reforms are always hard to do, right? Is there going to be the political will to get these reforms through, having already given, the cake away?
Yeah.
That's the worry I think we have. And so if you don't do these reforms, this is a huge amount of money. It's going to have an impact.
Yeah.
The question is, how big a bang are you going to get for your proverbial buck? And it's going to be less the less able you are to jam through some of these needed reforms.
Absolutely. Something we're monitoring very closely. Catherine Nice, Deputy Head of Global Economics and Chief European Economist over at PGIM Fixed Income, giving us her take this morning. Coming up on the program, tariffs in focus as foreign ministers gather at the ASEAN summit in Malaysia. We'll speak with a Canadian foreign minister right here on this program next. Stick with us. This is Bloomberg.
Welcome back. This is the opening trade, Thursday, the 10th of July. We have the latest trade headlines, of course, to work into the markets, and a little more besides in terms of the narrative and the news flow. Plenty of tech news over the last 24 hours as well. But the futures picture for Europe looks pretty resilient. And actually, European stocks were resilient. Yesterday, we saw perhaps the lower copper price ex-US was helping global stocks. We saw that in yesterday's session with autos going higher, construction going higher. Maybe we have another day of that in store for us. But I will just mention that not all the commodities are going lower, or that was yesterday's story. Perhaps iron ore prices, in fact, up today, up by 3.3%. And so that's something with the London market open in mind we will continue to watch. Kriti?
The stock market and the bond market perhaps marching to two different tunes, though, because when you look at the bond market, I mean, given it has only been 55 seconds and counting, you are only seeing a bit about 1 basis point lower. I think a little bit of a different story when it comes to what you're seeing in the States. But I think this is the key piece. And we just had this great conversation with PGIM's fixed income chief economist, Catherine Nice, there, talking about this idea of just how deliverable some of these promises are. And if you start to see a little bit of a wobble in the back half of the year after the European summer, this light volume, light liquidity environment fades. And of course, we are all on edge when it comes to the tariff story. How does that show up in the inflationary numbers? There is a bond auction later in the States that may test some of that appetite. But for now, when it comes to the European market, only seeing about a bid of about 1, maybe 2 basis points over in Italy when it comes to the open.
Yeah, at least, all these latest headlines on tariffs are really not slowing down this AI trade. It needs to be said that the beginning of the year, around the April 2nd, equities fell, tech took a massive hit, but now we see this next round of tariffs coming, and U.S. equities are still performing extremely well. Yesterday, NASDAQ 100 hit an intraday high. We saw Nvidia briefly become the first ever public company to reach $4 trillion in market cap, and we're continuing to see reports of companies making CapEx spending, making investments. Meta was a big one yesterday with a $3.5 billion investment in eyeglass company for AI, and then we also had reports of Amazon weighing a multi-billion investment in Anthropic as well. So this CapEx spending is continuing.
It might be entirely rational that tech stocks do well despite negative trade headlines, and for the market to look through the negative trade headlines and say, look, it's not going to be too material, or the effect on inflation is pushed a long way out, or for various perhaps very logical reasons not move too much on the tariff line. But the juxtaposition of these near all-time highs on the S&P, Nvidia at $4 trillion, at a time when we're talking about 50% tariff on copper, 200% tariff on pharma, they're just...
It's incredible.
It just feels, if you step back from those two facts, they feel like something... It feels like maybe, is this building up a vulnerability, I suppose, in stocks?
It absolutely is. And I think this idea of the stock market is not separate from the currency market, and that so many of these companies, Nvidia included, has this exposure abroad. It's not devout from the bond market story that's reacting to trade, that's reacting to FOMC minutes because of the valuations. Higher bond story, or higher yield story, to say, will affect the valuations there. So we'll see how long the $4 trillion stays at $4 trillion.
Yeah. OK, so Nvidia at $4 trillion, one of our big themes of the morning. Tariffs, the latest there, also a big theme. US Secretary of State Marco Rubio is scheduled to meet Russian Foreign Minister Sergei Lavrov on the sidelines of the ASEAN gathering in Kuala Lumpur. Of course, trade and tariffs will be talked about there, but no doubt this conversation very much more about defence and military. The meeting comes as the US prepares to send more weapons to Ukraine to help it fend off attacks from the Kremlin's war machine. Let's bring in Bloomberg's Min Min Lo, who is at the ASEAN Foreign Ministers meeting in Kuala Lumpur, and can give us some insights in what ministers there are thinking. Min Min.
Yes, it's a big day for ASEAN foreign ministers because they have dialogue with key partners, including the foreign envoys of US, China, South Korea, Japan, and Canada. And joining me here now is the Minister of Foreign Affairs from Canada, Anita Anand, on her first trip to Asia after a stopover in Japan. So, Minister, thank you for making time for us.
Having me.
Yeah, you just had your first meeting with ASEAN foreign ministers this morning.
Yes.
Just lay out for me, what is Canada's priority when it comes to the Indo-Pacific, and how will you compete with EU and Chinese influence in this region?
We are a Pacific nation ourselves, and I am here, the Carney government's first visit to the Indo-Pacific, my first visit to the Indo-Pacific, to stress the importance of multilateralism. Multilateralism in trade and economic matters in particular. We need to ensure that we're building resilient supply chains, that we are diversifying and we are establishing those trade relationships. We are currently negotiating with ASEAN a free trade agreement, and we look forward to the conclusion of those negotiations. In fact, I'll be meeting with the negotiators today, as well as members of the business community, because we have to remember that there are numerous stakeholders, businesses on the ground in ASEAN and in Canada who will benefit from this free trade agreement when it is finalized.
So how long can we expect? When will this thing be signed? And also, Canada already actually have pretty robust agreements with Asian countries. So how much more can this agreement actually push for expanding trade with this region?
You are exactly right. We have trade agreements that are very versatile and very robust with multiple regions and countries throughout the world. In fact, we're the only G7 country that has a free trade agreement with every other G7 country. But given the stress in the global economic environment, it is necessary for us to do more. And that is why this free trade agreement between Canada and ASEAN is so very important. We will be continuing to work with alacrity to finalize the text of that free trade agreement to ensure that those resilient supply chains for the benefit of business and other stakeholders continues to occur.
So what's the timeline for that?
Timeline is as soon as possible, and I also want to make sure that that continues. But we didn't just talk about trade. We also talked about food security, energy security, and digital and AI sharing. And on the issue of energy security and natural resources, let me just say that Canada is a powerhouse in the area of energy and critical minerals, and indeed the second shipment of LNG has left Canadian shores on the coast of British Columbia, and it was Petronas, a company that I'm going to be meeting with, that was leading that charge. And so we're very grateful to Petronas, to Malaysian businesses, and to those who see Canada as the energy superpower that it is.
Let's talk about some of the sectors that has been hit by sectoral tariffs from the US. So autos, steel and aluminum, these are sectors where Asian countries are also exporting the same products. So Asia is not likely to absorb the kind of supply from Canada. If you are reducing reliance from the US, where else will you look for market for those products?
So those tariffs are hitting us as well, and we believe they're unjustified, and we're engaged in complex negotiations with the United States to address the tariffs and to ensure that we can come to an agreement. On the subject of ASEAN countries and Canada, what we want to do is to continue to support multilateralism, to continue to show the world that as there is global stress in the geostrategic environment, Canada is a partner that will always show up to open the doors to trade, to open the doors to free trade, to open the doors to multilateralism.
So tariffs have obviously been looming over the summit. Everyone is worried about how it will cause trade diversion. Realistically, is Canada able to meet the July 21st deadline to reach a trade deal with the United States?
So those are negotiations that are occurring behind closed doors for a reason. They are complex, they're intricate, they involve multiple sectors, and we have a long-standing history with the United States. We have the longest undefended border in the world along the 49th parallel. $300 billion of trade passes through our borders every single day. This means that we must ensure an agreement is reached to address the needs of Canadian workers, Canadian businesses, and the Canadian population at large. But that is something that is being worked on as we speak.
Okay, your party actually campaigned on keeping elbows out and making Americans feel the pain. Why does it seem like Mark Carney actually seems less reluctant, more reluctant actually, to retaliate against Trump's policy so far?
Well, you have to remember that we do have counter tariffs in place. And we are ensuring that we're putting our best foot forward for Canada, for Canadian industry and Canadian workers. That means having supports at home for workers and industry where needed. At the same time, we need to make sure that the best deal is reached for Canada and for Canadians. And that's exactly what Minister LeBlanc and Ambassador Hillman are doing right now at the negotiating table.
You talk about the first and second shipments of LNG to Asia. Will you be looking at expanding new markets for LNG and also increasing supply to the EU over the longer term?
Critical minerals, natural resources, and energy overall are Canada's superpower. And we are continuing to leverage our competitive advantage wherever possible. In fact, we signed a security and defense agreement with the EU recently. We are working on a free trade agreement with the ASEAN. So we are spreading our wings broadly to ensure that we are leveraging our competitive advantage and we are making sure that we diversify. Diversification for an economy like Canada is the most important economic tool because we are a trading nation and we will always be committed to multilateralism.
All right, diversification really the key here when it comes to making use of the platform offered by the multilateral institutions like ASEAN. Thank you so much, Anita Anand, the Minister of Foreign Affairs of Canada.
All right, Min Low there at the ASEAN Foreign Ministers meeting in Kuala Lumpur, giving us that very timely conversation with the Canadian Foreign Minister. Of course, trade is one big topic today. The other is big tech. Coming up on the program, we are live at the Bank of America's Breakthrough Technology Dialogue, where our very own Tom McKenzie, anchor of Bloomberg Technology Europe, will be bringing us some very key interviews. He joins us now for a little taste of what to expect. Tom.
Kitty, yes, investors, entrepreneurs, academics all gathering here in the bucolic Sussex countryside for this dialogue, the Bank of America Breakthrough Tech Dialogue, with the focus, of course, on AI, on mobility, on health tech, on some of those bumper pay packages as well, the hunt and that drive for talent around artificial intelligence. Just some of the topics being discussed behind me. We've got some great guests coming up, including the chairman of Infineon, the semiconductor maker, of course, the co-founder, co-designer of the iPod and the iPhone, and the Bank of America International President, Bernie Mensah. That conversation coming up next. This is Bloomberg.
Welcome back. This is the opening trade. We have 15 minutes until the start of equity trading for this Thursday morning. The futures picture looks pretty buoyant. We could see some outperformance from London. I'm drawn to that strong iron ore price that we were talking about earlier, up by more than 3% over in Singapore. So perhaps that will set the stage for something strong from Basic Resources. We'll watch that, certainly. We're very focused on the tariff conversation, of course, also focused on a lot of the technology narratives that have been weaving their way through these markets, including Nvidia, up at $4 trillion. Market cap, briefly. Now, a good time for Bank of America to be hosting their Breakthrough Technology Dialogue, bringing together CEOs, entrepreneurs and investors to discuss technology and how technology is set to change business and the world. Our, no shortage of ambition there then. Our Daybreak Europe and Bloomberg Tech Europe anchor Tom McKenzie is there with the ambitious of the tech world and beyond. Tom.
Anna, thank you very much indeed. I'm very pleased to say I'm joined by Bank of America's President of International, Bernie Mensah, for a focus on some of those questions around technology, tariffs, and what's happening, of course, with global trade. Bernie, thank you very much for your time. What is top of mind, first of all, before we get on to tariffs and macro policy, what is top of mind at the Breakthrough Dialogue at a time where we're looking at Nvidia at a $4 trillion market cap? We're talking about the talent wars around AI. What is top of mind right now when it comes to tech and the kind of conversations that people are having right now?
Thanks, Tom, and good to see you again. I would say that we're trying to make sure it's not all about AI, but I'd say top of mind are all the ramifications around AI. It's interesting, when we did our first summit 4 years ago, we were on ChatGPT 2.0. Often people forget that was in the summer of 2022. In November, we came out with the generalized release of ChatGPT, which is based on 3.5. So the evolution of AI has been huge. We've moved into areas like agentic. We've moved into content engineering versus prompt engineering and thinking about all those other ramifications. So I think a lot of people are thinking, where is that story? Where is it headed? What are the pinch points? Is it compute? Is it data? What kinds of data? I think beyond that as well, we're trying to see, or there's a lot of interest in, how is AI morphing into other areas, synthetic biology, in the medtech space. What does that mean? In material sciences, is it feeding back onto itself? And one of the great things we have is we have a mix of people to be able to debate these.
And Bank of America and other banks, of course, are leaning into AI. Yeah. Where are you seeing, Bernie, efficiency gains as you implement some of these solutions across the bank?
Well, so we've been on the AI journey for a while. What a lot of people are talking about right now is generative AI. So in the AI space, we've been along there, and we've been leaning into that. We have Erica, we have 2 to 3 billion, contact points from our 70 million or so domestic clients in the US that are using in our retail space. On the generative space, we've been leaning in, trying to really think through our work processes, think through how we use data, trying to get efficiencies around the place. I was on the West Coast about a month ago, and I was talking to a very senior tech leader, and he was surprised at the small number of people that we use in our contact centers to support our incredible retail space. So we've already made a lot of progress there.
And is that, as we look at jobs being reshaped and the questions as to whether or not jobs get replaced or enhanced, is it at the back office? Is it the customer service where you see job displacement as a result of some of these AI products?
No, not necessarily. I think that was the point I was trying to make, which is that perhaps in some of the contact centers and back office, traditional AI, if I may call it that, has already had a lot of innovation. Look, I started in trading. We had 20, 30 FX traders. You'll have 3 or 4 FX traders now trading 10 times the volume. So that has happened. I think the interesting with generative AI is that it's so creative, so transformational, that we all need to step back and rethink how we do things. We have to throw the old orthodoxies away. And so that's the process of working through. So I think every firm has a few specific areas, with junior bankers, with some of our operations areas, absolutely. But the idea is to really take some of these proof of concepts and see if you can get better compliance, whether you can get better, trader metrics, better analytics to help your clients.
Do you think longer term, though, you will need fewer junior bankers?
Unclear, because I think that, when I look at, my analogy perhaps might be in the trader space, you might need fewer FX spot traders, but you have a few more FX options traders. You'll have a few more structured FX traders. You have more time to talk to corporates about their asset liability management as you have some of the macro wins that are taking place. So the junior bankers might not be creating pitch books in the way that they were, but perhaps they might be, analyzing industry trends a lot better, perhaps feeding in other data that hadn't been accessible before and seeing how we can use that to help our corporate clients.
On the macro front, a reminder this morning in terms of the tariff volatility, with tariffs threatened 50% on Brazil, 50% on copper, yet global stocks are close to record highs.
Yeah.
Is that rational to you, or is there complacency in these markets?
I think we say the markets are always rational at some level at some point in time. I think that the markets are pricing in there's so much more information now versus early April. And I think what the markets are saying is, okay, we have a lot of information that might come in on specific tariffs. You mentioned the ones that came through last night. But looking through that, where do we see value, or where do we see, opportunity? So in very specific sectorial areas and specific companies, I think people see value there. I think in other areas, some value has diminished, absolutely. So the headline numbers may be where they are, but I think what we need to look through is say, where in tech is it doing, or where in the supply chain might things not be doing so well.
And in your conversation with corporate clients, what are they telling you in terms of where the cost of tariffs lands? Is it squeezed margins, or are they passing the cost on to the consumer?
It's interesting, because also you're trying to look at that in the inflation data and saying, is that going to hit? When is it going to hit, right? So a lot of economists' projections on, is there a recession? A lot of that has diminished. In our fund manager survey, the confidence in terms of, I would say the US economy and the broader economy is much better than 2 or 3 months ago. I think from the corporate space, my sense is that there is some absorption of the cost there. It'd be really interesting to see as we get through Q2 what earning results are like. So there's been some sense that there's some absorption of the cost, but there's also real efficiency gains. There was some pre-stocking coming up in March, and 1 or 2 have sort of said, well, we had a 4 or 5 month, maybe 3 or 4 month horizon in terms of where tariffs might settle down. Then we know what to do. We're in that zone now. We're sort of 3 or 4 months in. I think if there were further volatility around tariffs, then things might be back on the drawing board.
And as a US bank, but with your global purview, the time you spend internationally, we've heard from some banks that they're losing out on bond deals, for example, to domestic banks because those clients don't necessarily want to deal with US banks as much. Are you seeing that at all? Are you losing out on any bond deals as a result of that to domestic
I haven't, and
players?
I have been asked that a couple of times. There's been nothing that has hit my radar. We have to be out there all the time, and I think our proposition, which is trying to be close to clients and provide that value, remains. And I think there's very few of us at our scale that can do that, across the globe. So as we're in the C-suite, in the Treasury offices, in the CFO's office, I really haven't seen that.
Before we let you go, on the Fed, I was speaking to the UBS O'Connor CIO yesterday, and he said markets are underestimating the risks to Fed independence in 2026. Do you agree?
I'm not sure if they're underestimating it. I think that if you look at the forward prices in the markets, the markets are pricing where they think rates will be next year. I think in that price signal is some sense of what they think the Fed's reaction function will be next year. I think for all of what we hear, the market data will be what it is. I think the 10-year rates where they are reflects a reasonable assumption as to what growth rates will be. So independence or not, I think there'll be a range of there'll be a sort of a range of activity or a range of outcomes that I think the Fed will look to work towards.
Bernie Mensah, thank you very much indeed. President of International Bank of America, of course, at the Bank of America Breakthrough Technology Summit and Dialogue here in Sussex. Guys, back to you.
Tom McKenzie there with the Bank of America President of International. We thank you so much. In the meantime, we're about 5 minutes away from the opening trade across Europe, seeing a couple of key sectors we want to keep an eye on. Of course, Brazil and the tariff read-through is certainly one of that. The FX impact there. Got one eye on WPP as well, which we know was in the news yesterday as well.
Yeah, absolutely. Big drop in WPP, 19%, I think you said, Val, in yesterday's session on the back of that profit warning. We knew that the CEO was leaving, but they confirmed this morning the name of the new CEO, so we'll see how the market responds to that.
Absolutely, and ironically, the new CEO was a former Microsoft exec as well. So there's a little bit of a read-through from the tech story permeating throughout this day. In the meantime, take a look at what futures are doing, which is kind of an interesting dynamic here. Red in the States, green right here in Europe. It is the opening trade, 5 minutes time. Stick with us. This is Bloomberg. A few minutes to go until the opening trade. I think there's two key dynamics you really need to keep in mind that might set us up for today's session. A lot of that has to do with this chart. The S&P 500, of course, closing with Nvidia hitting a $4 trillion market cap. And you can see this right up and to the right, green on the screen across the board. So what does that mean for Europe? Because in the States, it means taking a little bit of a breather, retracing from those gains. In Europe, maybe a little bit of a catch-up, Val.
Looks like we are adding to the gains in European stocks from yesterday. Euro Stoxx 50 futures up 0.33%. We are seeing some outperformance in the FTSE 100 futures up nearly 0.7%. There is some outperformance in basic resources. Take a look at the jump in iron ore that might be helping out some of the companies listed here in London. DAX futures also in the green, up 0.4% as the rally in European stocks rolls on. Anna, what kind of single names do we have in mind today?
Yeah, well, we certainly have WPP in focus. This is a stock that lost 19% yesterday, a profit warning from that business. We knew that the CEO was going. Today we got the announcement of the new CEO who's coming in to the business, and an industry so much AI conversation taking place within that industry, so certainly a lot to watch there. When it comes to the shippers, we've seen some further attacks on shipping in the Red Sea. Now, many of the listed shipping companies don't go through the Red Sea right now, so we will see whether there is any reaction there, and indeed if it looks as if they will be kept out of the Red Sea for longer, then that could be a positive for their stocks, as we've seen in the past. UK Homebuilders will continue to watch those moves as well, because we've seen some better news coming through on the real estate sector, the housing market specifically in the UK from the latest numbers. Kriti?
Absolutely. Lots to digest when it comes to the opening trade. We're seconds away to see where the outperformance is. Is it a catch-up trade at the end of the day to what we saw in the States yesterday, or a breather, or maybe just a little bit of a hodgepodge? It is, of course, the open across those European markets. The FTSE 100 is flat right out of the gates. But let's see if it does some catching up, because there are a lot of individual stories we want to keep an eye on. Anna, you just mentioned the shipper story. We have plenty in terms of the banking sector as well. How does that show up in these markets? Stock 600 higher by 0.2%. But I should remind our global audience as we start to get this pricing in, light volume, light liquidity. It is a European summer. It's a Thursday as well. So how much buying is there happening perhaps after a risk-off Friday is going to be key. The IBEX about flat at the moment. The DAX, though, your outperformer alongside the CAC curve on higher by 0.4%. So all indications, Val, suggest it's a risk-on day in Europe.
Yeah, let's take a look at the sectors on the move so far in the first moments of the opening trade. We are seeing basic resources at the top of the basket. That sector outperforming this morning, up 1.9%. This did underperform yesterday around the copper story. We seem to be undoing that. There was a big jump in iron ore prices due to some positivity around Chinese property. We are seeing Rio Tinto, one of the biggest gainers at the open, up 3.5%. Glencore already as well at the top of the basket, up 2.3. So it does seem like basic resources given a bit of a boost today, undoing some of yesterday's decline.
Yeah, indeed. And we're keeping an eye on what's going on with WPP. Of course, we mentioned that one. That stock looks to be a little firmer this morning, just up by 1.4%, though, in the context of all the losses of yesterday. That is not a huge move, but maybe trying to draw a line in the sand with the naming of the new CEO. So, Valerie, yeah, you're right to point to basic resources. Some real strength coming through there. I see that Telefonica is one stock in the negative, and we were talking about the Brazil link a little bit behind the scenes earlier on around Telefonica. So that's certainly something we'll watch. The telecom space in general, though, pretty flat today as the markets look kind of risk on here in Europe, which, as you said, Kriti, earlier, is in contrast to US futures, which have dropped a little. And actually, yesterday we saw a different dynamic playing out across the Atlantic.
We should mention also that tech isn't really featuring in terms of the heavier trade here. And I think that's really crucial because on the one side, you have the Nvidia $4 trillion headline. You have cost savings out of Microsoft. You also have TSMC numbers in, I want to say, about 90 minutes ago that hit the wire. Numbers that came in kind of hot. And ASML, which is the pricing I'm looking for at the moment, maybe not reacting with as much enthusiasm as before. It is literally flat on my screen, trading about 680 euros in Amsterdam right now. Where is the tech trade? Maybe our next guest will have an answer. Virginie Messinov, Global CIO, Equity at Allianz Global Investors, joins the program this morning. Virginie, a pleasure to have you on the program, as always. Let me put that question to you here. In a world of uncertainty, in a world of geopolitics, in a world of searching for carry and yield, does tech check those boxes?
Yes, of course it does. Although we've had, as you know, a fantastic rebound, right, since the April lows. And you have this new Nouvelle Donne with the latest news on tariffs. I think we're probably due for a consolidation. In that environment, people may take some profits in some of the tech stocks that they've done well into. But in my view, once that consolidation goes through, or during that consolidation, you should add to your tech position on a long-term basis. And I think, what's really happening when you see the 4 trillion, tipping point on Nvidia, this is the long-term trade. This is the trend that's shaping the global economy. This is digital Darwinism, et cetera, and this is not stopping here. But it's done very well in the short term, right?
It's fascinating, though, because I think we're bringing back the conversation of things like valuations, for example.
Yes.
And there's been a really interesting conversation about comparing the AI momentum trade over in the States and Silicon Valley, 4 trillion on Nvidia, et cetera, with these massive valuations in the defense trade. Val made the point earlier that does this actually show up? What's being priced in? Do you think that's fair? Are valuations too high in Europe right now, and specifically in defense?
So let's step back. What's going on in Europe right now? You have a currency that's starting to bite a little bit.
You think it is?
I think it is, yes. I think if we, personally, I believe in the next quarterly earnings, people will talk a lot about this. It's starting to bite. So where does the dollar go from here? It's not so much about the euro than the weakness of the dollar, right? You have an environment where we have a lot of hope around this fiscal support. So where is the execution, right? Is it well executed? When do we start seeing the impact? Is it next year? If it's next year, yes. There's a rarity factor in the valuation of some of the stocks in Europe that we're talking about, right? And then there's the global environment and the geopolitics. So you can paint a positive scenario if you think we have a global slowdown. Then you have a US-induced and European fiscal support-induced capex supercycle that includes tech, right? But you also have potential issues around stock-specific and the impact of the dollar and potential political upheaval again in Europe. So it's balanced. So I would be quite careful. As I said, I think we could have a consolidation that would give people an opportunity to buy.
All right, we always like buying the dip, I guess, here.
Yeah.
Virginie, I want to talk about the fact that we've gotten a bit more clarity on tariffs this week, except for when it comes to the EU. There still seems like there's a lot up in the air when it comes to carve-outs. Is there anything, you're specifically watching as maybe there might be some dips to buy off of any of these announcements when it comes to carve-outs in pharma or autos, for example?
I think you really have to think of the tariffs as three buckets. The first one is the universal tariffs bucket. 10%, market is ready for that. The second one is the sector tariffs. So the copper, the aluminum, the pharma, the autos. And in Trump's mind, I believe he is trying to correct this unfairness of trade for the U.S. and bring production back to the U.S. And then you have the third bucket, which is the reciprocal tariff, where he's trying to shape other countries' behavior. And there it's Europe and defense, it's Asia and transshipment, et cetera, et cetera. So all of those three buckets are at play. My personal view is that by August 1st, we won't have full clarity. But what we may have is a bit more on the sectors and a bit more on the framework, the same way we have a framework now for China, although it's a short-term one. Right? Remember, on rare earth, etc. So I think this is the path that we're going to. Otherwise, it's just way too much. I mean, there was a really good article yesterday from Bloomberg about the number of hours that were spent by people, in the trade delegations going around the world to try to negotiate, this U.S. deal. And I think this is a lot of time, right? Spent. There's no way it's going to get done by August 1st. So to go back to your question, I think there's positive upside, but what I'm also watching is what Europe is doing with China. I think there's a huge opportunity for Europe and China to get closer together in this environment.
Surely that would irk President Trump.
Exactly.
And that's not something that they want to do at this point.
That's not something, but at some point you have to also think about your own future, long-term future. So I'm still not disregarding it completely, although I think that's probably a lower probability than it was a little while ago. And in this environment, so you go back to volatility, bottom of stock prices, what do you want to have in your portfolio in 12 months, 18 months, 3 years, 5 years, and take advantage of that volatility and uncertainty if you think the prices are right.
But there's two ways you can view the tariff delay. You can do it in a negative risk way, as in this is just going to overhang uncertainty. People are going to pull back on investment. Or you can just think that with the tariffs being delayed, everyone just continues to discount their implementation.
Yes.
You see
Other cans have been kicked in the past. We have kicked cans down roads for a very long time.
So is it positive or negative?
Well, so it really depends. And also, if you look at the 50% on Brazil, what is really the rationale behind it, right? So there's a bit of moral suasion, is that what we call it? Or kicking the can down the road, yes, there's a credibility issue. At the same time, with the bill passed, or, he needs that revenue. So he will want to have some wins, a bit at the Vietnam kind of deal, to show that he can bring revenues.
And do you think, so we hear the message from the Trump administration, they say that consumers won't pay this, US consumers won't pay tariffs, it'll be paid by suppliers. Lots of guests around this desk disagree with that and say, actually, this will stick to the US consumer at some point. The timing seems to be in question. But I was really drawn to this story about Japanese car exporters dropping their prices in June by 20% because the tariffs have come in on cars. And I wonder if that teaches us anything. I mean, maybe it'll be both in the end.
Yes.
But the balance between the two, will it be suppliers' margins or will it be consumers? We just don't know yet, perhaps.
Yes, and we've talked about this, in the past. So you're going to have currency absorption, margin absorption, and consumer absorption. And this will be molded based on the elasticity of demand of the final products. And
so it'll be sector-specific,
sector
industry-specific,
and the willingness for companies to want to stay in the US market, right? I think that's really important. However, the impact of inflation so far has not been felt because we've had this back and forth. But if you went to a full tariffs, right, say starting October or whatever, you will start seeing what is a very unpopular, measure, which is a tax on consumption, hitting in 2026.
Yes.
So I think the timing is very important. At the time when there's an issue that I think we haven't talked enough about is immigration. So we've already had a reduction in the past 4 months of 1 million people from the labor force. 20% only of employment in the US comes from the S&P 500. The rest is small and medium-sized companies. And as those detention centers get built,
yes,
you're expecting much more to take place. What is the cost of that on the workforce?
And that's going to be also inflationary then?
That is inflationary.
Yeah.
So, the year-end labor cost increase expectation is around 3.5%. Who knows if there's an upside element to this, right? In a population, a labor force that we know because of demographics is not growing that much. So it's those are elements that, of course, will have an impact on rates. So then you go back to the slowdown in the economy that we would be expecting for the next 2 quarters, right? But then you have the BBB and the CapEx potential super cycle that could be very powerful. So in this environment, what does Powell think?
Okay, Virginie, thank you very much. Thank you for joining us. Virginie Mazeneuve, Global CIO Equity at Allianz Global Investors. A lot to think about this morning. 11 minutes past 8 here in Europe as European stocks are moving tentatively higher, less tentatively in London, with Basic Resources doing really well. Let's have a look at the core 6, though, and see how they are performing. Some of the big names around Europe. We have a decent move higher in Schneider Electric, up by 0.7%. LVMH, Novo Nordisk also moving higher. In fact, all of them in the green, which is the opposite of yesterday, where all of them were selling off. Let us get some more detail on some individual stock movers now with Joe Easton. Good morning, Joe.
Morning, Anna. So one place selling off today is the chocolate space. We've got a bit of a drop down in some of these names this morning. Barry Callebaut is the driver over in Switzerland. A profit warning out of the company, warning of weakening volumes, particularly in America. The Americans not eating enough chocolate, according to Barry Callebaut. So they're downgrading their guidance today. This is coming off the back of a jump up in cocoa prices that really squeezed margins. That was a lot due to bad weather over in countries like the Ivory Coast in Africa. So it's kind of a double impact on the firm. But now they're warning actually of a cutback on the demand side, on consumer side. So Barry Callebaut, that was down around 10% at the open, coming up very slightly, feeding through into Lindt as well. Much more of a recognisable name. Barry Callebaut is more the white label, sells into supermarkets that do their own chocolate, that kind of thing. Nestle kind of holding up for the moment. Then we've got our focus on Brazilian stocks, of course, given the news out overnight from Trump around a 50% tariff on goods sold to Brazil. From Brazil into the US, getting that the wrong way around there. But that is the deal there. And these stocks all exposed. So Telefonica gets around 20% of its sales, its revenue in Brazil, and therefore the currency dropping. The Brazilian real slammed overnight, and that is feeding through into Telefonica a little bit. Santander as well, a big exposure to Brazil, of course, so that one dropping, and also Mapfre as well, insurance. So 3 Spanish stocks, and also there are some in France and also other countries as well, including AB InBev was one I had on my radar, holding up okay at the moment. Carrefour a little bit weak, a lot of Brazilian exposure for that one. So we're keeping an eye on companies exposed to Brazil, given the drop down in the real overnight. Then the main sector driving gains today is the miners. As was mentioned a few moments ago, rebounding following that drop yesterday. Iron ore prices overnight up around 3%, so potentially that's having an impact. Bit more of a positive tone coming out of China as well, so a bit of positivity feeding through, but really erasing most of the drop that we saw in the mining stocks yesterday. So positivity on miners today. Then, in terms of another mover, we had Gerresheimer over in Germany. Now, this is the company that makes the syringes used by Novo Nordisk for their weight loss drugs and other packaging products as well. Earnings out of them, but it is a takeover situation. They have got bids coming through from private equity. The ongoing story there's potentially not a huge focus on the numbers, but that was called a little bit weaker, coming back up very slightly. Finally, ending on a morning call, Commerzbank downgraded at Bank of America. Bank of America says Commerzbank is the best way to play the increase in fiscal spending in Germany. So that is positive. However, we can see that stock, it's doubled over the one-year view in terms of the valuation. So Bank of America thinks that the valuation is too high. They're downgrading Commerzbank today, and that was slipping very slightly over in Germany. Commerzbank downgraded at Boffa this morning.
All right, Joe Easton there from our equities team with some of those early movers, about 15 minutes into today's session. We thank you so much. Coming up on the program, President Trump unveiling a new round of tariff rates, confirming a 50% levy on copper imports. It's been a theme permeating throughout the markets. And today's show, we're going to dive into the impact in the commodity sector next. Stick with us. This is Bloomberg.
Welcome back to the opening trade, 8:18 here in London on Thursday, the 10th of July. A positive session for European markets. We have some strength coming through, in particular in London. Basic resources up by 2.8%. This is an iron ore story, a China story. It seems there's some optimism around the real estate sector there, and that's giving us a boost here in London. So that's the standout sector. Let's talk about the markets more broadly then. Joining us now to talk about the markets in 3 minutes, Bloomberg's Paul Dobson with details on the market moves. Paul, Brazil seems to have attracted a lot of attention because of the motivations behind the tariff, the size of the tariff, the unexpected nature of the scale of the tariff on Brazil. How much from a market's perspective does this matter, do we think? Clearly, it's having an impact on some European companies that have exposure.
Yeah, it certainly raised a lot of eyebrows in Latin America when the news broke at the end of the US day yesterday, Anna. And local markets really came under the cosh. You know, we saw the real down about 3% and local ETFs similar amounts. And, you know, the fact of the matter is that Latin American currencies have been performing extremely strongly this year, so it's a little bit of a take back from that, and it's still performing well. But all things being considered, you know, it's a nasty jolt, as you said. Now, we were wondering at the start of the Asia Day, how much of a contagion risk is there into the rest of the emerging market complex, in particular other BRICS nations? Didn't really see it. Quite surprisingly, markets seem to shrug it off and see it as a sort of individualized case. And once again, this idea that, you know, it's the sort of escalate to de-escalate kind of thing from Donald Trump and trying to make his point. Nonetheless, as John Authers argues in his column today, which is a really good read, this is politics and economics getting a bit muddied and melded together, and that's quite a confusing signal for everybody to take away. The other thing, I think, watch out for coffee when it trades later today, and, you know, what that means for chains in the US and for inflation outlook and for people's day-to-day expenses as well. So Brazil is such a big supplier of coffee to the US.
Paul, you mentioned confusing signals there. I think that brings us on to this Chinese story that property shares surged on unverified reports of a high-level meeting. What's going on in Chinese markets? Because it's had an impact on iron ore, on basic resources. Iron ore is up some 3.4% on the speculation.
Yeah, and Chinese property stocks up 10%, sort of judging by one gauge at least. Not entirely sure, but it seems like there's a possibility that there'll be more briefings, more supportive measures coming through for the policy sector. China in general seems to be getting there with some extra sort of fiscal measures, talking about involution and the need to stop that kind of like cutthroat price competition as well to try and sort the market out. So more positive signs there. That's helping push the onshore gauges to the highest levels of this year. People starting to feel a little bit more optimistic in general about the Chinese economy.
All right, Bloomberg's Paul Dobson. We'll talk just a little bit about China and a little time about tariffs. In our last 30 seconds here, Paul, I want to very quickly ask you about the dollar in all of this. The dollar has weakened against G10 currencies, but strengthened against EM. Why is it not weaker?
Yeah, why is it not weaker? Well, I mean, it's had a pretty punishing ride already this year. But I think that what's really interesting is this Goldman Sachs sort of talking about the idea that it could trade more as a risk currency and less as a haven currency is interesting. You know, obviously under a lot of pressure already from the perceptions of what the Trump administration is doing to its image and the possibility of Fed cuts. So it could continue to weaken. We're just seeing that little bit of stability right now.
Bloomberg's Paul Dobson, we'll let you go now. Thank you so much. Walking us through some of those currency moves around the world. We really appreciate it. You can get more analysis from him and the team. MLIV Go is a function on your terminal. In the meantime, let's talk about how it's all showing up in the stock market story, because you are seeing a giant boost when it comes to those mining stocks. Rio Tinto, Glencore, among others, for example. Even Antofagasta getting a bit of a bid this morning. Anglo American also part of that. A lot of that is coming from the iron ore move. Some of it, however, is also coming from the copper story. The U.S. president has confirmed that a 50% tariff on copper imports will take effect from August 1st. Donald Trump pledging that America will build a dominant copper industry of its own. Bloomberg's metals and mining reporter Mark Burton all over this story. Just walk us through the commodity trade here and how it all plays out.
So the past 6 months, this trade has been gathering steam, starting in February when Trump first formally kind of outlined plans to impose an unspecified tariff on copper. He instructed the Commerce Department to kind of investigate what the scale and scope of that tariff should be. Those reviews typically take up to 270 days. And at that moment in February, everyone started to anticipate that these tariffs would come in. US copper prices jumped relative to the other global benchmarks set in London and Shanghai. And for physical traders who move copper around the world, it opened up a huge opportunity to take metal from elsewhere in the world and move it into the US to cash in on those higher prices. And we've seen that trade taking place in huge volumes over the past 6 months. Now, with the slightly unexpected announcement that tariffs will be set at 50% and will come into effect in August, we're in the last gasp of that physical trade, and we're seeing some very unexpected kind of shipments being made where traders are effectively just racing to get copper to any US port and clear it via customs in any means possible. So traders are looking at Hawaii and Puerto Rico, for instance, just to
because it's quick to get to.
Because it's quick, exactly.
Yes.
We have kind of 20 days left.
Yeah, 20 days left, so there's a sort of scramble. So what we've seen so far, so yesterday I was reading that Goldman Sachs, ahead of the announcement of 50%, thought that the market was pricing in a 14% tariff on copper. And then we got the news of 50. Yeah. And now if you look at the spread between New York and London, it's not 14 and it's not 50. Yeah. So what does that spread tell us about what the market is now thinking? Yeah,
so the market consistently throughout this period has been kind of looking for precedents in a fairly unprecedented situation. Copper, steel and aluminium tariffs were imposed under the first administration, and they've been ramped up in the second. And so people have been saying, OK, well, perhaps it will be set at 25%, which was the rate on steel and aluminium, at least up until recently. But there's a lot of uncertainty there, and quite consistently the market has been pricing about 50% of the consensus tariff. So when it was 25% as a consensus, the market was pricing 12.5%. Today, we know more or less that it's going to be 50%, but the market is still only pricing about 25%. And I think that really reflects an ongoing uncertainty about the kind of finer details of the tariffs, particularly the products that will be included, and whether there will be immediately or over time significant carve-outs for major producers. OK,
that is an interesting angle, isn't it? And one that some of the detail that we'll no doubt have to watch then. Thank you very much for that. Mark Burton, Bloomberg's metals and mining reporter. We'll come back with more on these markets. London really outperforming then on a commodity story, not really to do with copper today, to do with iron ore, but the copper story continues to be one that we're watching for the reasons Mark has set out. A lot of uncertainty around exactly how that gets implemented. But European stocks go higher. US futures actually weaker, though. This is Bloomberg. This is the opening trade. We're 30 minutes into today's session. It's a positive one for European stocks, in particular the London market up by 8 0.1%. Mining stocks really flying this morning. Higher iron ore prices on the back of some interesting narratives developing in the Chinese real estate sector. No doubt growth in China of interest to those who are focused on the oil market. The OPEC seminar continues at pace in Vienna after the alliance endorsed a bumper oil output increase last weekend. Goldman Sachs says it's all about normalizing production by the group.
In my view, OPEC's voluntary production cuts were always meant to be temporary. OPEC always signaled that it had the flexibility to bring barrels back to the market when it would judge that there is room. And so far in the spring and the summer, the market reaction suggests that there has been room to bring barrels back to the market. More broadly, I would contextualize the decision to raise production in a broader context where OPEC is aiming to normalize market share, normalize spare capacity, and also to further improve cohesion with the group. And we have seen improvements in compliance with the production cuts as well.
Yeah.
Head of Global Commodities Research, Dean Stuyven, staying in Vienna then with the events developing there. Let's talk to Bloomberg's Jumana Besetcha, who joins us from there now. So, Jumana, a lot for the ministers to digest or to talk about, I suppose. Clearly, we saw this decision at the weekend. That's been the direction of travel for quite a long time. More production from OPEC and friends. What is on the minds of ministers as they gather there at that event in Vienna?
Yeah, so this is the second day of the OPEC seminar. And remember, this is actually the first physical meeting in years for many of these OPEC ministers. Some of the non-OPEC big industry names are here as well. Some of the CEOs of the biggest companies around the world, Shell, Total, all were here alongside industry analysts. So really an opportunity for people to get together and talk about some of the pressing issues. Now, you mentioned the most recent decision out of OPEC, and that, of course, has gathered a lot of airtime, not just for us, but in general, people here having discussions about how they see the evolution of the oil market in the coming months. And I think some of the comments that we had yesterday from the likes of the UAE oil minister, Suhail al-Mazrou'i, him saying that actually, despite the fact that OPEC had managed to put back these extra barrels to the market, they haven't seen a massive uptick in inventories, which was notable, i.e. they did see a window of opportunity to start supplying extra barrels to the market. That is also echoed by some of the more bullish commentary that we've heard from some of the big state oil companies. So Aramco CEO Amin Nasser was speaking on a panel yesterday. They've always been very bullish on demand, specifically coming out of Asia. And he said that he thinks that demand will settle in the 1.2 to 1.3 million barrels per day in the third quarter and fourth quarter of this year. Similar reflections coming through from the CEO of the Kuwait Petroleum Company. We spoke to him yesterday. We interviewed him. He also sees healthy demand as well. And so it seems to be the case that for many of these oil producers, they actually did see a window of opportunity because of healthy demand signals coming through. And of course, that contrasts with much of the analysis that has been put out by Wall Street over the last couple of months, where many of these big banks, including the likes of Goldman Sachs, who we spoke to this morning, are expecting to see a supply glut as soon as the fourth quarter of this year and going into the beginning of next year. So for now, what you're seeing is OPEC have managed to deliver those extra barrels without much of an impact on the oil market. We have Brent still trading around $70, but the expectation is the market balance may change in the coming months once the seasonal demand pushes out of the way in the summer and you start seeing that extra supply hitting the market, as well as some of those demand signals perhaps not manifesting as high as those oil producers have suggested.
Jumana, how much of those bearish signals are really coming more from the rates that shale producers or even Pemex has hedged at? Do you have insight on what those figures look like?
Yeah, interesting on shale. So yesterday we were speaking to Bob McNally, who obviously is a big name in the space in Rapid and Energy. He's got a lot of clients based out in the U.S. And he was saying that talk of oil trading at around low 50s is really not something that is palatable to oil producers, shale oil producers. And actually what you've started to see is a moderation in production out of the U.S. this year. If you look at the number of active oil rigs in the U.S. this year, dramatic decline. We're back to levels not seen since September 2021. So actually, drill, baby, drill hasn't really transpired in the way that President Trump would have hoped for. At best, what you're getting is perhaps a leveling off of production or a slight increase of production. Analysts are saying we could see something like a growth of 100,000 to 200,000 barrels per day. So not a huge massive uptick in supply expected there. But where people are expecting the biggest non-OPEC supply growth to come from is off the Gulf of Mexico, off Latin American countries, Brazil, Guyana. There you could continue to see a continued output increase. And of course, from OPEC Plus themselves, because not only have they finished or are about to finish putting back this 2.2 million barrels per day that they took off the market a couple of years ago, there's also another 1.66 million barrels per day, another tranche that they could start thinking about bringing back to the market as well. So you could see another uptick of more than 1 million barrels per day coming from OPEC as well.
Jemana, thank you very much. Really interesting that OPEC sees the demand picture so differently to Wall Street right now. We'll see what transpires for the rest of this year. Jemana Boseccia joining us there from Vienna. Coming up on the programme, don't miss our exclusive conversation with the Bank of America Breakthrough Technology Dialogue, or from that event, sorry, with Tony Fadell, principal at the Build Collective and co-inventor of the Apple iPod. I'm assuming people know what that is. I'm just going to go with that assumption. If you don't know, Google it. Look it up on ChatGPT. That's next. This is Bloomberg. Welcome back to the opening trade. We are 39 minutes into our European trading session. The stocks in Europe are up. The stocks in the US, or futures for them, are down. That's what you need to know about the way that the tariff story is being digested by different markets on different sides of the Atlantic differently. Basic Resources is doing pretty well for the London market right now. Now, we've mentioned this a couple of times. I've mentioned this in jest. We are going to be speaking to one of the co-founders of the iPod in just a moment, and that prompted me to wonder whether everybody who's watching, or even everybody around this desk, is aware of what an iPod is. Now, the point of this conversation is not to point out that I'm old and others are not. The point of this conversation is just to go back down memory lane. But, you know, Valerie, I didn't have one of these. I had a Shuffle, I'm just remembering now, which was
pretty great,
even smaller and even more screenless than the things we were just showing.
Gosh, I remember this technology coming out in high school, and it was just riveting that you didn't have to carry around your CD thing and these awful headphones and your stack of CDs. It was all in one nice little box. But Kriti, what was your...
I miss the wired headphones that went with the iPod, and I feel like I lose my AirPods all the time now.
This happens,
but for me, my first iteration was the iPod Touch at the time.
Precursor
very
to
cool.
the iPhone.
Very, very cool. It didn't have iPhone capabilities, but I could check the weather and write some notes. And
what more do you need,
exactly.
frankly? And you had a lot more time for other things.
It was
back
a simpler,
in the day.
more glorious time.
The glory days. Let us keep that conversation in mind as we head back to Bank of America's Breakthrough Technology Dialogue. It's taking place in Goodwood in southern England today. The birds are chirping, the sun is shining, and Bloomberg's Tom McKenzie is on the road. Tom.
And I love that conversation because, of course, we are joined now by the co-founder of the iPod, of the iPhone, Tony Fadell, of the Build Collective as well, and founder of Nest Labs. So let's get to Tony right now. They're having a conversation in the studio about the iPod, which, of course, you co-invented, you co-founded. What was that moment like? Did you have any idea as to how that technology was going to change the way we interact with music, with audio, and ultimately with the iPhone as well, in terms of our devices to communicate?
Well, it was truly bringing, audio into the digital world. It was the internet at the time, and MP3 was taking off. Everyone was stealing music. So it was clear that people wanted digital music. So it was great to build that device. But Apple was in a very, very different place back then than it is today. It was worth less than $4 billion, and it was highly in debt, and it was close to not making payroll. So a very, very different Apple than now. It had no retail stores either.
Wow.
So to know that iPod was going to be the success it became inside of Apple, was Apple going to actually succeed in the next quarter? It was really, really dicey, and it obviously paid off. But it was a very, very different time for Apple.
Apple was also almost not making payroll back then?
Yeah, actually, it had to sell its ARM shares. It owned a part of ARM. It had to sell its ARM shares to actually make payroll back in the late 90s. So
how challenged is Apple right now, to the here and now, Tony? You still understand this technology. You still look at Apple very close. How challenged is Apple around AI right now? How much of an existential moment is this for an Apple that is seen as behind the curve when it comes to implementing integrating AI and shipping AI to its customers?
Well, first of all, we have to understand it might not be shipping AI itself to customers, but it is an incredible platform for delivering ChatGPT and various other AI technologies. So it's not like it's behind in terms of being able to offer AI. It just doesn't offer Apple AI to its users. So it's a platform that has incredible momentum, and that momentum is going to continue. Because think about it, Apple has basically commercialized the family. You have the iPad, the iPhone, you have your watch, you have your AirPods, you have your Macs, you have your iCloud. So literally, families will not switch. It's kind of back in the days of like Microsoft being enveloped in a business. They couldn't switch. Microsoft is still in those businesses. Apple will still be in those families for years. So as long as AI can get into the system, most people will not go switching to another platform anytime soon.
The trade representative within the Trump administration, Peter Navarro, said yesterday, Apple thinks it is tariff-proof. It's too big to tariff. What is the biggest risk for Apple right now? Is it tariffs in this trade war, or is it playing catch-up on AI?
I think right now I think it's both. But look, tariffs are tariffs, and they're going to be blanket across everybody in the industry that comes into the U.S. So Apple, while it's expensive, and it might get more expensive, everybody else will get more expensive. So it's all relative. So maybe people will switch, but again, they have gotten such a grip on your life, Apple does, that it's hard for you to switch. You might not upgrade as often. That might be the difference. You might not upgrade, but to change your platform is very, very difficult to see. Whereas AI, they have such momentum and such profitability. If they choose to get really, bold about it, just like what Meta's doing, paying $200 million packages to engineers and everything. If Apple wants to get bold, it has the money to get bold in data centers. It has the money to buy all the engineering talent and all the various other startups around to build an AI. But they have to get bold, and they have to make some big decisions.
What do you mentioned that $200 million pay package for a key Apple engineer, and Meta and Mark Zuckerberg have been poaching aggressively for their superintelligence lab. What do you make of these pay packages and what it signals?
Well, what it signals is people are really saying this is important, right? So Mark has a certain way of playing. Mensah has a certain way of playing. Each company has a certain way they play. When messaging was big, Mark Zuckerberg had no problem spending almost $20 billion to buy WhatsApp that had tons of users but no revenue. Okay, so Mark plays a certain game. He did the same thing with VR, which didn't pan out, but in the WhatsApp case, it did. So he's going to play that same bold game around AI to really win. He tried first, now he's going to go and do it. So this is a big market, no doubt about it. And you have to play differently if you're coming in late. So Mark's saying, I'm going to go buy whatever I need to make this happen. I believe Apple is going to have to do that, and even more so. But luckily, both companies have huge cash pools to be able to do this.
So that talent competition only heats up from here?
Absolutely, but there's only so much talent. But at the end of the day, the talent pool is going to be. I wish I was an engineer again. I wish I was going to be that rock star, NBA player that was an engineer, back in the day. When I started my career, I was making $29,000 a year, so it's very different than $200 million. So
yeah, that's quite the gap, isn't it, Tony? Look, I want to draw on that experience with hardware and that historic role you played with the iPod and the iPhone, and think about hardware devices of the future integrated with AI. And we talk about embedded AI, so AI on the device. What does that look like? What does that mean? Where's the value going to accrue?
Well, first, when you move AI to a device, and we're starting to see it, when I did Nest, we were the first consumer product to actually have AI integrated into it. We couldn't call it AI because it would scare people, but we had AI in a thermostat. So you're going to see more and more of these things all embedded with AI. And so when we talk about on persons, though, not just in general products, but on persons, we already have AI, like I said, on your smartphone, on your computer, what have you, but it's going to become much more contextually aware. So the sensors, to make AI smarter, you need to have better context. And better context means you have more audio input, more video input, more temperatures. You could imagine all kinds of other sensors. When AI understands that, when you ask it a question, it can answer much more concisely for you and more accurately and more quickly. So what you want is more sensors. So think about this. Today, we already have lots of sensors. We already know GPS. We can do all that stuff. If the AIs get access to that, today a lot of privacy concerns around that. But if you get access to that, if you wore a device that actually had audio input and video input all day long. Think of those police cameras, right? And you could take all that. The AIs can see what you're seeing, hear what you're hearing, and start to be able to make much better context models. So when you ask a question, who am I talking to right now? It can respond instantly because it's already looking that up and already seeing your picture and mapping it to what's out in the world.
Does that spell the end of the smartphone in 5-10 years?
Absolutely not. The best way to represent visual information is not in your ear, is visually. So a smartphone, if you look at, I've heard many years that I heard the iPhone's going to get killed, the computer's going to get killed. Look, we still have laptops today. We still have smartphones. We have watches. When you add another device in, they get layered in. It doesn't replace anything. The only way things are going to get replaced when the intelligence is so good in the network and in all the devices that we can start removing things. Today, we're going to just keep layering on because we need more context, we need more sensors for input to make the AI smarter. One day when the AI is so smart and it acts like a person, we can start to remove things, but that's a long way away.
That's more than a decade away.
I believe it's probably at least seven years away, maybe 10 years away, before we're going to start seeing the number of devices that we have around us go down.
Okay, and you're investing in companies, you're on boards, you're investing in companies in the UK, in Europe, you're focused on the edge computing, you're focused on Nothing, which is a smartphone maker based in the UK now, with that pedigree as well. What are you not investing in when it comes to AI? What is looking frothy or bubbly to you? What are you avoiding?
Well, I'm not investing in any of the foundational models, the OpenAIs of the world, Anthropics, those things. I'm not investing. I'm either investing in things around data, sensors, or compute, or I'm investing in applications. AI is not an application. AI is not a product. AI is a technology. When it's productized for a certain given market, when it's understood what it can deliver, not just hallucinations. I have a company called Nabla. Nabla is one of the #1 medical scribes in AI. It's been going for 7-8 years now. We're conquering the U.S. When we say it doesn't hallucinate, it works well for doctors, you can guarantee that it works. That's when you sell AI, and you sell AI for very, very high value. It's when you have these hallucinating consumer products. Sure, you can sell to consumers, but businesses don't buy that.
Okay, on the enterprise piece, it's different. Before we let you go, what does AI do to jobs? Which jobs are most at risk? If not now, then in 2, 3, 4 years' time, Tony?
All junior level jobs in any industry are at high risk because I'm already on my small team. We're able to augment our highly trained professionals with these things to be junior research assistants, to do these different tasks that we would normally hire people or outside services to do. And we're not doing that anymore because we can get it done in 10 minutes for what we used to do that take a week or two. So junior level positions, I'm really worried about, and the schools need to train kids to uplift to be middle level and more experienced workers. Not just, hey, we're going to come in and we're going to train you as a business. Businesses are not going to be training their workers like they used to, saying, I'm going to take interns and these things. They need to have experience, and experience not just with the tools, but working experience before they're actually going to get in the job market now.
Okay, that's the challenge for the education system.
Absolutely.
Then. Tony Fadell, thank you very much.
Thank you.
Co-founder, co-inventor, of course, of the iPod and the iPhone, of the Build Collective, and founder of Nest Labs. Anna, Kriti, back to you.
Bloomberg anchor Tom McKenzie there with the co-founder of the iPod. Tony doesn't know this, but he's had a big impact on my life via the iPod. We thank you so much for that interview, Tom. In the meantime, he was talking about AI, he was talking about the applications and where that takes us. Nicely, I think, to Nvidia's valuation, briefly topping $4 trillion in the New York session, retreating just a little bit, but still certainly a milestone event. Speaking to Bloomberg at the annual Allen & Co. Sun Valley Retreat in Idaho, Steve Paglucha of Bain Capital reacted to the soaring valuation.
It's going to revolutionize productivity. It's going to have the same impact the internet had 20 years ago, and it's going to be a 20-year run, and that's why NVIDIA's value is so high, because they're in the catbird seat of the chips needed to power that revolution.
Bloomberg Intelligence Senior Analyst Robert Lee, of course, following that story very, very closely. Robert, what does a $4 trillion market cap on NVIDIA signal to you?
Well, I guess it's another feather in the cap for Jensen Huang, another sort of global first. So that's all great, makes great headlines, etc. But coming back to taking a more realistic view on the outlook for AI at the moment, in terms of the infrastructure play, NVIDIA remains the only play in town, doesn't it? It's an effective monopoly in terms of what it does. Intel, AMD, and others are trying to catch up, but Nvidia's got such a commanding lead in terms of time, in terms of technology. It's hard to see how any of them can realistically challenge them in a meaningful way, and on a short-term view. So it's got a market to itself at a time when the big tech platforms in the States continue to spend humongous levels of capex. So based on our latest data, if you look at the big four platforms, so really that's Microsoft, Meta, Amazon, and Google, they're spending combined capex of over $300 billion this year. So, it's a fantastic setup. This will go back in the stock market and economic history books. But this is all known news. And I would say, arguably, the risk profile and the uncertainties that Nvidia faces on a medium-term view, if we look at it today versus where they were maybe 12 months ago, it's actually a little bit higher incrementally. I'm not saying they're about to fall off a cliff or they're facing, dramatic uncertainty in the near term. But as you know, many of their end customers are looking to design their own chips. I think whilst they have a commanding lead, the competition is slowly catching up. There's also the uncertainty about their China business. As you know, we've had the bans on the H20 that caused a write-down of $5-6 billion in terms of inventory. So again, I think on the margin, in terms of incremental risks and uncertainties, I would actually argue they are greater today than they were. So why is this stock trading at an all-time high at the moment? I think there have been a number of short-term factors which have benefited them. Obviously, we've seen, the concerns on tariffs have eased relative to where they were earlier in the year, so that's helped risk-on sentiment. We've obviously seen President Trump maybe trying to, use the right language here, persuade the Fed to cut rates. So obviously that is normally good for markets. It's been risk-on environment driven by some short-term factors. And just very briefly, Jensen Huang is due to take a visit to China. He's going to meet China's premier next week. Again, I think that's a short-term factor which may well drive risk-on sentiment. But as I said, taking a step back from the noise and the headlines, I would argue, or I do argue, that the risk outlook for this company and the uncertainties are actually marginally greater today. So, I think we'll have to wait and see how things evolve over the coming year or two. And then finally, if you allow me just 5 seconds, a point I keep coming back to is monetization. I mean, obviously, Nvidia's in a great place at the moment while these big tech platforms are building out the infrastructure, while they're building out the tools and the models. But if you look at Microsoft as an example, Microsoft's due to spend $80 billion in capex this year. There is a story on the terminal today, a reported story from their chief commercial officer that Microsoft has saved around $500 million in terms of operating costs as a result of applying AI in a business. So that's great. But, they're nowhere near to commercializing or making a meaningful ROI, I should say, on that very high level of capital spending.
Robert,
so that's,
thank you very much.
That remains the elephant in the room.
Yeah, some context around the $4 trillion. Thank you so much, Bloomberg Intelligence Senior Analyst. A quick word on some things that are still coming in the trading day ahead. We have, Valerie, you said it at the top of the last hour, the earnings story kicks off, doesn't it, stateside? We've got US initial jobless claims. Of course, it's Thursday, so that would be the case. We get an auction, a US Treasury auction as well. But that hasn't caused too much drama, has it, over the last couple of days?
There has been a string of long-end auctions this week that have gone okay. So it seems to have reversed a lot of the weakness that we have seen recently in fixed income. Let's see if that continues with the bond auction at 6 p.m. tonight.
OK, in the next hour, Francine Lacroix has a great lineup on the Pulse. The MSCI CEO, Ralph Lauren CEO, and Lavazza Chair will be joining the business. That is it for the opening trade. This is Bloomberg.